Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Phil Mackintosh, Chief Economist at Nasdaq, to discuss the housing sector. We'll also learn how REITs and private real estate are different and the reasons why. Phil, it's great to see you as always, and I want to talk about housing here because part of the narrative for 2022 was housing strong, labor strong, consumer strong. Now we're starting to see housing dial back a bit here. So what are your thoughts, how we should be approaching housing right now?
Yeah, I mean, it makes a lot of sense because interest rates have gone up 4% this year. The mortgage rates have gone up 4% this year. They went over 7% recently. And so you'd expect it's going to get a lot more expensive to go buy that house to pay off the mortgage. And so what we've seen is applications have been slowing. They're actually down pretty low at the moment. They're at the sort of peak COVID lows, so not many people are really coming out and applying for mortgages and trying to buy houses. So with that, you've seen the prices of houses are starting to tip over, but they haven't come down as far as you would expect given the rise in interest rates and the change in affordability.
Let's talk about return to office. Because I can tell you anecdotally in the city, I feel like Tuesdays, Wednesdays, that's when everyone's in town. Perhaps you could say the same thing about Thursday, but Mondays and Fridays are a ghost town still.
Yeah, so different kind of real estate, but similar related problem. With COVID, we saw obviously a lot of offices were empty, and when you look at the data, it looks like a lot of offices still aren't filled up, to your point. So New York City is at like multi-decade highs for occupancy right now. And the real question is, with those spaces, like what's going to happen to leases, what's going to happen to office rentals, and what's going to happen to the office REITs?
Right. It's so interesting. Before we get into REITs here, I just want to anecdotally mention something that part of the challenge is it is so expensive to convert older properties, for example, that don't have the Wi-Fi and the open spaces and so forth that companies are looking for. But to rectify that, it is incredibly expensive to remodel them or convert them into residential housing, which is, of course, the major cities need. So I think that's interesting that we have all this space, but it seems there's really no strategy to be able to rectify that. Anyway, let's move along to REITs here. What are you seeing in that space?
Yeah, so we just talked about housing and the fact that it's not moving, the prices are not moving very quickly. And that's because as an asset class, like you don't trade a house very frequently. There's not a marketplace for it. There's not a bid and an offer. The interesting thing about REITs is they are listed on a stock exchange. And so all day, every day, you see all the buyers' bids and you see all the sellers' offers, and you get price discovery much more quickly. So if we look at what's happened in the REIT space, so REITs are real estate trusts, when we had that sort of initial COVID period where everybody wasn't coming to the office, it's true, office space actually fell a bit. A lot of hotel REITs fell a bit. What was gaining was the industrials, the self-storage. So a lot of like Amazon was struggling to basically deliver enough packages because we're all getting packages delivered. What's interesting is as interest rates have increased, even those real estate properties now have similar kinds of valuation problems. And so we've seen the whole REIT complex sell off. But what's really interesting is the office REITs have sold off more than all of the other REITs. And actually the REITs that have held up have been the retail and the hotels, as we've all started to go back and spend and get a little bit more of our personal life back to normal. Maybe not our office life.
And while I have you here, I'm going to have to ask you your outlook for 2023. We're always focusing on macro, right? That's kind of been the story for 2022. When do you think that narrative starts to shift and we start to focus on fundamentals? Do we have to get through earnings season in Q1, looking back for Q4? Where do you think that rebase takes place?
Yeah, I mean, I think globally, everyone thinks we're getting pretty close to peak interest rate hikes now. And so that's going to let us pivot to look at how companies are performing a little bit better. If we see unemployment tick up, it's a bit of a worry because we might fall into a recession where people are worried about losing their jobs and they spend less, which makes earnings come down and sort of creates a bit of a vicious cycle for valuations and for job security. And so that's one thing we've got to focus on is if unemployment starts to tick up, watch out for recession. But if it doesn't, and we can actually, to your point, keep spending high enough and keep companies with profits, then as rates come down, that's actually a tailwind for stock valuations and it should actually help the market next year.
All right. Appreciate the insight, Phil. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.